If you are investing in index funds or thinking about starting, this conversation was created specifically for you today. Most people are told index funds are safe, simple, and almost impossible to mess up over long periods. I believed that idea for years, because safety feels comforting when financial decisions already feel stressful. When money feels uncertain, choosing something labeled safe seems like the smartest move available. But here is something very few people explain clearly when they casually recommend index funds. Chikuarbi, even investments considered safe, do not all lead to the same financial ending over time. Two people can invest the same amount in the same market and still end up extremely far apart. That difference is usually not luck, intelligence, or perfect timing, which surprises most people deeply. Before we go further, gently tap like if you appreciate calm, honest conversations about money like this. It helps me know these slower, thoughtful financial discussions are actually helpful and worth continuing regularly. If money decisions quietly follow you around, consider subscribing so you can learn without pressure or hype. You can also comment 100K if you have ever wondered what $100,000 really represents. On paper, $100,000 sounds solid, responsible, and like a strong financial milestone. In real life, that same number feels completely different depending on where and how it is invested. I have seen people feel calm with index funds while slowly drifting further away from their long-term goals. Key. I have also watched others start with the same amount and quietly build very different outcomes. This video is not about hype, shortcuts, or trying to beat the market with risky strategies. It is about understanding why safe investments can still create very different financial futures over time. Once you truly see this pattern, your view of index funds will probably never feel the same again. So let us begin with an honest question most people avoid asking themselves when investing their money. If you have ever felt unsure despite doing everything responsibly, this next part will probably feel uncomfortably familiar. Most people are not reckless with money. They work hard, save consistently, and still feel quietly behind financially. In the United States, incomes have risen over time, but the cost of living has risen even faster. Housing, food, insurance, and energy now consume a much larger portion of most household paychecks every month today. After covering basic expenses, many households are left with very little margin to actually save anything over time. Ipori. That is why keeping money in cash often feels safe, yet quietly loses purchasing power each year today. According to official inflation data, $1 today buys meaningfully less than it did years ago for families. This slow erosion is easy to ignore because it happens quietly, gradually, and without dramatic headlines every day. So people naturally look for something safer than stocks, but better than leaving money idle in bank accounts. That is usually when index funds enter the conversation as the responsible, sensible middle ground for investors everywhere. I remember choosing index funds because I wanted progress without constant worry or emotional stress about money decisions. They promised diversification, low fees, and simplicity, which sounded perfect for someone wanting peace of mind, financial stability. And to be clear, index funds are not a bad choice or some hidden financial trap for everyone. They are designed to grow with the economy and reward patience over long periods of time for investors. The problem begins when people assume safe automatically means predictable or equal outcomes for every single person involved. Wedreitu. Safety reduces the chance of disaster, but it does not guarantee the same destination for every investor over time. This is where most investors misunderstand what index funds actually do beneath the surface of their portfolio's planning. They focus on the word safe without thinking about structure, exposure, and long-term compounding effects over decades. And that misunderstanding is exactly why $100,000 can quietly end very differently for different people. To see how this happens, let me walk you through a simple, real-world example that anyone can understand. Twideroth. Imagine two people starting with the same $100,000 and investing during the same exact years. They both choose index funds, follow common advice, and believe they are making responsible long-term decisions. Neither of them is trying to gamble, trade daily, or chase risky market trends for fast profits. On the surface, their choices look almost identical and equally safe from a distance. But beneath that surface, their money is actually traveling along very different financial paths quietly. I like to think of index funds as vehicles rather than destinations in your financial journey. The vehicle may be safe and reliable, but where it takes you depends on the route chosen. Some routes move slowly and steadily, avoiding sharp turns and emotional ups and downs along the way. Other routes are bumpier, more uncomfortable, and require patience during long stretches of uncertainty. Both routes can be considered safe, but they clearly do not end at the same place. This difference becomes massive when you give time enough room to quietly do its compounding work. Over 10 years, small differences feel manageable and easy to dismiss without much concern. Over 20 or 30 years, those same differences quietly grow into life-changing gaps in outcomes. This is why focusing only on safety can give a false sense of comfort over long periods. Safety protects you from collapse, but it does not promise growth that meaningfully changes your life. What actually matters more is how your investment is structured beneath the comforting label of safety. Structure determines which companies you own, how fast they grow, and how volatile the journey feels. Most people never look this closely because index funds are marketed as simple and hands-off. But simplicity does not remove the need to understand what your money is actually exposed to. Once you see this clearly, the idea of safe investing starts to feel very different. Let me start with the most common path people choose when investing $100,000 for long-term security. This path feels comfortable because it mirrors familiar advice from friends, co-workers, headlines, and professionals people trust deeply. It concentrates on large established companies that appear stable, recognizable, and essential to everyday American economic life today. These businesses generate consistent profits, dominate their industries, and feel reassuring during uncertain economic or market conditions periods. When investors choose this route, their money grows steadily without demanding constant attention, emotional resilience, or frequent decision-making. Account balances slowly rise year after year, reinforcing the comforting belief that everything is working exactly as planned. There are market drops along the journey, but they usually feel temporary, explainable, and emotionally manageable for most people. This investing style helps many people sleep better at night, especially during recessions, headlines, or short-term volatility. After 10 years, $100,000 often grows into a number that feels encouraging and emotionally reassuring. At 20 years, the portfolio looks respectable, meaningful, and clearly superior to simply saving money in cash accounts. By 30 years, the balance may reach several $1 million, which sounds impressive to most people initially hearing. And to be clear, this outcome is not failure, incompetence, or poor investing by any reasonable standard measure. The issue is not what this path achieves, but what it quietly leaves behind over decades of time. While this money compounds steadily, other investment paths are compounding at dramatically different speeds simultaneously over time periods. Those differences are extremely subtle early on and nearly invisible without side-by-side long-term comparisons made. Most investors never compare outcomes because their results feel good enough and comfortably within expectations over time horizons. Comfort slowly turns into confidence, and confidence often reduces curiosity about alternative structures or long-term possibilities available. That is how many investors remain on this familiar path without realizing other options even exist for them. Again, this choice is not wrong or irresponsible, but it does shape very specific long-term outcomes eventually. To fully understand those outcomes, we need to explore another path that most people rarely consider seriously today. This next path is often ignored because it feels less obvious, less discussed, and slightly uncomfortable at first. It sits between the extremes, not dominated by giants, yet no longer fragile or unproven young businesses today. I think of these companies as people past survival mode, but still hungry to grow rapidly and meaningfully ahead. They have proven products, stable revenues, and leadership teams focused on expansion rather than mere survival today globally. Because of that balance, their growth can quietly outpace larger companies over surprisingly long periods of time together. Florida. When I first learned this, it challenged my assumption that bigger always meant safer or better for investors long term. This path includes companies growing faster, paying healthier dividends, and reinvesting aggressively for future gains consistently over decades. Over time, those qualities combine into compounding that feels almost boring early, then surprisingly powerful later for investors watching. With $100,000, this path often produces outcomes that start separating meaningfully after many years pass. At first, the difference feels modest, easy to dismiss, and not worth changing course emotionally initially for most people. But decade by decade, those slightly higher growth rates quietly reshape the entire financial picture for families over time. This is where many investors suddenly realize safety did not mean sameness in outcomes for everyone long term. They look back and see years where small differences compounded without much attention or excitement from them daily. What felt boring and unremarkable early on now explains a noticeably wider gap in results between portfolios today. This is why ignoring this middle path can quietly cost more than people expect financially over decades long. Dewey, it does not scream excitement, but it often rewards patience more generously than expected for investors over time. For many people, this path balances emotional comfort with meaningful long-term growth better than extremes available today. However, it requires understanding and patience, which is why it rarely gets much attention from media or friends. Most advice skips this explanation, jumping straight from safe to extreme without context for beginners investors often online. That gap in understanding is exactly where many long-term outcomes quietly diverge financially over time for families. Wider. Some investors take this middle path further by aligning growth with long-term changes shaping the broader economy. They focus on industries quietly expanding as society evolves, rather than chasing short-term excitement or familiar brand names. When I studied this approach, it helped me see safety through a wider and more realistic lens overall. Safety was no longer just about volatility, but about staying aligned with where growth was happening economically long-term. This perspective matters because economies change, and investments tied to yesterday often struggle tomorrow without adapting to new realities. With $100,000, these shifts can quietly amplify results without requiring extreme risk or constant attention. Many people overlook this because the benefits do not show up clearly within just a few years initially. But over decades, aligning investments with evolving sectors can significantly reshape outcomes for patient investors who stay committed long-term. This is where safety begins to look less like protection and more like thoughtful positioning within changing markets today. It still avoids reckless bets, but it accepts that change itself creates opportunity when understood early by investors. Of course, not everyone is comfortable with this idea, especially when results fluctuate during transitions between economic cycles. That discomfort is often the price of growth beyond what traditional safe paths usually deliver over long horizons. Still, this path does not represent the most extreme version of growth available to investors in markets today. There is another direction that pushes far beyond comfort, patience, and emotional stability for many long-term investors. This direction focuses heavily on innovation, technology, and companies reshaping how the world operates at massive scale today. Dur. It offers extraordinary potential, but it demands the ability to withstand intense volatility without panic during market cycles. This is where many investors either build life-changing wealth or exit far too early from fear alone. With $100,000, this path can feel uncomfortable long before it feels rewarding for most people. The swings are sharper, the headlines louder, and the emotional discipline required is significantly higher over long periods. Yet this is often the path responsible for the most dramatic differences in long-term outcomes across diversified portfolios. This path is not built for comfort, stability, or reassurance during uncertain moments in the market cycles. It is built for growth, innovation, and long-term conviction in how technology reshapes economies worldwide. When I first explored this path, I underestimated how emotionally demanding the journey could become over time. Prices move faster, headlines feel louder, and short-term losses can appear suddenly without warning. Many investors enter confidently, believing they understand risk, until volatility tests their patience repeatedly. This is where fear quietly convinces people to sell at the worst possible moments during market downturns. The irony is that those painful moments often happen just before long-term gains accelerate significantly. Staying invested here requires trusting innovation, even when markets temporarily punish progress and long-term potential. With $100,000, this path magnifies both emotional discomfort and long-term opportunity simultaneously. Over shorter periods, results can look disappointing, chaotic, or even irresponsible compared to safer alternatives. But over decades, compounding fueled by innovation can transform modest beginnings into extraordinary financial outcomes. This is how some investors see their portfolios grow into numbers that once felt completely unrealistic. However, those outcomes only belong to people who remain invested through long stretches of uncertainty and doubt. Most people struggle not because the strategy fails, but because emotions interrupt the process too early. This path rewards patience brutally, demanding emotional discipline few people realize they truly possess initially. That is why identical starting amounts can create dramatically different endings depending on emotional endurance alone. The difference is not intelligence, research, or access to information available equally to everyone today. It is the ability to remain calm when the strategy feels wrong before it eventually proves right. This explains why extreme growth paths feel unfair when comparing results years later across different investors. Now that we have seen these paths clearly, it is time to step back and connect everything together. When I step back and look at all these paths together, one pattern becomes impossible to ignore over time. Index funds themselves are not misleading, dangerous, or broken in any fundamental or hidden way. The confusion comes from assuming safety automatically guarantees similar outcomes for everyone investing long-term. Safety only reduces the chance of disaster, not the size, speed, or direction of eventual financial progress. What truly separates results is structure, exposure, time, and how patiently someone stays invested through discomfort. Courage. Two portfolios can both be safe, while quietly compounding toward dramatically different destinations decades later. This is why comparing returns without context often creates frustration, doubt, and unnecessary self-blame among investors. People wonder what they did wrong, when in reality, they simply chose a different long-term structure. Once you understand this, investing feels less like guessing and more like intentionally choosing a path. You stop asking which fund is best and start asking which journey fits your temperament and goals. That shift alone removes enormous stress, because clarity replaces constant second-guessing and comparison with others. Index funds are tools, not promises, and tools only work as well as how they are used. $100,000 is not small or large by itself. It simply reflects potential waiting to be directed. Over long periods, potential becomes reality through consistency, patience, and alignment with how markets actually behave. This is why some people quietly build wealth without drama, while others feel stuck despite doing everything responsibly. The difference is rarely effort or intelligence, but understanding what kind of outcome each structure creates. Once that clicks, fear softens, decisions slow down, and confidence becomes grounded rather than emotional. Investing stops feeling like a test you might fail and starts feeling like a process you can manage. And that perspective matters far more than chasing perfect timing, trends, or headlines promising easy answers. With that clarity, we can now talk honestly about what $100,000 is truly capable of. When people ask whether $100,000 is enough, I think they are asking the wrong question entirely. The better question is what kind of future you are quietly building with that money over time. Enough is not a number. It is the relationship between expectations, structure, patience, and emotional discipline. $100,000 can feel disappointing or extraordinary depending on how intentionally it is positioned. Index funds give you access, but access alone does not determine where you eventually arrive financially. What matters more is understanding what you own, why you own it, and how long you are willing to wait. Many people underestimate how powerful clarity becomes once they stop chasing reassurance and start choosing alignment. Alignment between goals, temperament, and structure quietly does more work than constant action or frequent adjustments. When those pieces align, investing feels calmer, decisions slow down, and confidence replaces background financial anxiety. That calm is not passivity. It is the result of finally understanding what path you are actually on. If this video helped you see index funds more clearly, take a moment to reflect on your own choices. Ask yourself whether your current investments match the future you hope they will eventually create. If this perspective resonated, gently tap like so more people can find these slower, thoughtful conversations about money. Share this video with someone who feels confused despite doing everything responsibly with their finances. And if you want to keep learning without pressure, hype, or fear, consider subscribing to the channel. Ways. I focus on helping people think clearly about money, not telling them what to buy or sell. You do not need perfect answers. You just need a framework that makes sense to you long term. That framework grows stronger each time you choose understanding over fear and patience over impulsive decisions. Thank you for spending this time with me and thinking more deeply about what your money can become. In the next video, we will explore another quiet financial idea that changes how people see progress completely. Before you move on, take a moment to think about where your money is actually headed right now. Not where you hope it goes someday, but where its current structure is quietly leading it over time. That awareness alone can change how you feel about investing more than any market prediction ever could. Because clarity creates calm, and calm helps you stay invested when emotions usually push people away. You do not need more information. You need fewer assumptions and a clearer understanding of your own path. When you remove confusion, progress feels slower at first, but far more dependable over long periods. That is how ordinary investors quietly build meaningful wealth without constant stress or dramatic decisions. In the next video, I will show how small, consistent actions compound into surprising financial progress over time. It is not about earning more, but about aligning what you already have with realistic expectations. If that sounds useful, I will see you there, and we will continue this conversation together.